Raising capital for the gaming sector. Is gaming still a sure bet?
Okay, well, that's a hard act to follow. That's a class act to follow. But we've got three of the most distinguished people that I've had the pleasure of knowing in our industry, who have really operated at the top level in the financial markets, supporting the growth of the casino and iGaming industry. It's my pleasure going my left to right, Reuben Portanier, partner at GTG. I've known Reuben for a while. He hails from Malta, having formerly been the CEO of the Malta Gaming Authority. He was an advisor to the government of Malta on gaming and EU regulatory matters, and he has been so highly recognized and awarded as an individual, as a leader in the gaming industry. It's a pleasure to have you, Reuben. To his left, Adam Rosenberg, a senior advisor at Blackstone, former partner at Fortress Global, head of gaming and leisure, 17 years at Goldman Sachs. We're so lucky to have someone of Adam's stature to talk about issues regarding the raising of capital for the gaming sector. Welcome, Adam. And Nick Harding, chairman of EAG Expo, 40 plus years in the gaming industry. I rarely meet someone in as long as but it was a real pleasure to meet Nick. He's been with some of the biggest operating groups in the world, Coral, Bass, Rank Groups, founder of Spray Lakes Consultancy, past president of BACTA, and a key figure in EU and UK trade organizations, and a philanthropist. Nice to have you. I'm going to kick it off with the first question. I'm going to try to just run through a series of questions. We don't have a lot of time, and we have three of the best experts on the topic. So the first question is, how has access to capital for gaming evolved recently, and what's driving investor caution, regulation, or growth uncertainty? And we'll just start with you, Reuben.
Okay, thank you, Stephen. So we're talking about how financing has evolved across time. So going back 25 years when online gaming started, everything started off from private investment. You had your own sort of savings. You created your own small online site and started off. At that time, it was easy because the investment required was quite minimal. Fast forward now 25 years, and you have the complications of having to deal with marketing, having to deal with compliance in multiple jurisdictions. If you're a game developer, you have to manage to develop, 12 to 25 games per month for you to be relevant. And that all requires financing. And we've seen an evolution going through, maybe going in two different parts from my experience. The first being that of generating finance from within and reutilizing your profits, the traditional way. Or if not managing to do that, bring in normal financing options, the traditional ones. The other route was going for public money, going for bonds, going for listing opportunities. Both parts have different nuances to them and give you different results. It all depends on the objective that the company needs to portray.
Thank you, Reuben. Adam?
Well, I'll just add the institutional investor point of view across two flavors, public investing and private investing. And to touch on some of the themes we've seen recently, I'd say it's become more challenging for private capital raising. 2 years ago, it seemed all kinds of disruptive ideas, especially in the iGaming industry, had a pretty easy time raising capital at very high valuations. those vintages now are re-raising capital, often having to go back to existing investors, sometimes having to do down rounds to sustain the growth of their businesses. And I see that really as a normalization of what were elevated valuations 18 months or 2 years ago. But good private companies are still able to attract capital. The type of capital has changed a bit, and we'll talk about, later in the panel, equity and debt and hybrid types of investing strategies like cohort financing, which is very relevant to online gaming businesses that need to feed their growth by spending on customer acquisition. And in the public markets, again, staying within the iGaming space, we've seen a real dislocation over the last few weeks in the valuation of some of the big iGaming operators. And it really has to do with the changing regulatory landscape and the uncertainty around certain disruptive types of offerings like prediction markets, sweepstakes gaming, and other things that are still in the process of resolving themselves. And when you synthesize that, to me, really as an investor, you're trying to strike a balance between the risk you're taking and the reward you can get from putting your capital to work. And as the uncertainty increases around the businesses you're investing in, the reward you will demand for your capital also increases, and that results in a lower valuation. And when you have a public company where you can see the valuation every minute of every day, that will correspond with lower valuations, and I think we're seeing some of that now wash through the publicly listed internet gaming operators.
Thank you. One follow-up. Do you have a prediction on the future of prediction markets?
I predict continued uncertainty.
Okay, very good. Nick?
Well, we're certainly seeing uncertainty in the UK market, whether it's the threat of increased regulation. We've got a budget coming up in about 2.5 weeks' time, and the Chancellor, Rachel Reeves, is talking about increasing the tax on slots. Of course, slots underpins everything, as we know. Ahead of this, I thought I'd reach out to a couple of people that I know that have invested with me in the past. And I'll just read you a quick email I had back from one of them, and he said there is so much constant noise and interference from government. And he said, we have always had a policy of supporting low-value item gambling, and this remains our policy. But he said, I suspect in practice, we'd probably steer away from any deal in the sector currently. And I think that sort of sums it up in a nutshell. In the UK, and certainly I think in Europe as well, I think people are nervous. We've seen an increase in taxation in the Netherlands. Net result, apparently 25% of the business is closed. Net receipts to government are down 200 million euros, and they've got a second tranche, another increase in gambling tax in January. So,
Nick, one follow-up there. Do you see this as a short-term issue lurching from one group in power to another, or as a long-term trend in the UK and Europe as a whole?
I mean, as you said, I like yourself, I've been in the business a long time. And that there is always an issue. There's always something that operators, business owners have to deal with. In the UK, I've never known it this bad. Mm-hmm. It really is quite difficult. And I think as an investor, unless it's a private investor, I think people are going to say, I'm going to get my fingers burned with this, possibly. Or can they justify that investment to their board? Maybe they can't. So it's a difficult time. And it is being replicated elsewhere.
Well, given the headwinds you've all alluded to, I think that brings up a follow-up question for all of you. Given these headwinds, which financing options, private credit, leasebacks, you reference cohort financing, which are proving to be most effective in today's environment?
Well, cohort financing is I believe, sort of like a mainstream that you can go for. It's an easy way to finance. One thing that maybe should be taken into account is why do you need the financing in the first place? Because that actually routes you to the type of financing option that you want to take. So if you're going to go for you need financing for something which is of a recurring nature, then yeah, you can go for cohort financing. But if you need financing to do something of a capital nature, like you need to come up with a gaming platform, a game development platform, which will increase your balance sheet because you are actually going to capitalize the software development, then you would go for a different type of financing, possibly bringing in either some venture capitalists or even going public. So it depends. You have the scope of a private shareholder is to see that the upper line of your P&L is as great as possible. You want to have a lot of revenue figures. Whereas the investors, they're concerned about the bottom line. So there are two different areas, and it depends on what the objective is.
Thank you. Adam?
I want to tie something Nick said to your question about financing, because I think he made a very important point, which is the change in regulation and the impact that has on the ability to be comfortable with investing. In my experience, regulated gaming is a kind of one-way ratchet. It only ever expands. It doesn't ever contract. But as it expands, it comes with new regulation, increased taxes, never reduced taxes, increased challenges to incumbent operators, and that all gets synthesized into how investors think about the investability of a sector and then specific companies within that sector. And it's easy to forget that the gambling industry, the regulated gambling industry, comes with an added layer of risk around it because you have this untethered partner in every business, which is the government regulator. And they really can change the rules, and often do. And then the operators have to respond to that, and their capital providers have to respond in turn. So it's something that's easy to forget, but there's a reason why, in my opinion, gambling businesses that produce the same cash flows and the same growth rates and have the same margin story as comparable businesses will always trade with a premium return or a lower valuation. To get to your question, just to touch on cohort financing, because it's sort of the flavor of the day, for people who don't know what it means is instead of an equity investment that is the riskiest part of the capital structure, or a debt investment that typically has credit protections and the ability to attach to assets if the loan can't be serviced or repaid, cohort financing is sort of a hybrid where it's a loan. It's not really a loan. It's capital provided to a company to fund capital spending or customer acquisition spending in exchange for a revenue share. And it gets paid out of the top line, which is very attractive to the capital provider. It is not dilutive like equity would be, which is attractive to the operator, and it doesn't burden the company with debt that attaches to the assets and can trigger a default or other complications for the operator. So it has to be done carefully, but it is gaining traction. I see it with lots of funds that I invest with and funds that I know that want to understand this style of investment, the pros and cons, and I think we're going to see more of it.
Is there a market that sets the pricing for cohort, or is it a one-off negotiation every time you consider it?
It began as a one-off because there were relatively few capital providers who were doing it, but it's very quickly settled into a range of returns. I would say they are kind of low to mid-teens returns, sometimes more, which sounds very expensive, but again, if it enables the companies to grow without dilution and without the teeth of traditional debt, it can still be very attractive. And the reason I said, I caught myself, I described it as a loan, it really isn't a loan. The more it looks like a loan, the more you have to worry about other things like usury laws, where if the interest rate, quote unquote, is too high, you may have other problems. So it needs to be done properly with appropriate legal counsel so that the investors don't trip into something they don't intend to.
It sounds like what we used to have in casinos, mezzanine financing with a PIK, a participation. It probably doesn't have as many features of a debt Cohort doesn't, it sounds like.
Yeah, there's lots of ways to structure it. But the way they avoid being characterized as debt, which nobody wants, is to have a target return. And if the target return is reached, the principal gets paid back and it retires. And now you could reload that for the next cohort.
Right.
And then you get into discussions about crossing cohorts. So if one does well and one doesn't, the investor can still get the benefit of a diversity of revenue streams. So you can get quite creative with it.
Excellent. Nick?
Yeah, I'm with you actually, Steve. And I grew up in the sort of world with mezzanine funding with a pick. But it's the same sort of thing, although probably more aggressive. I think what that does do, cohort funding, it stress tests management's thoughts about the business. You can't present yourself and we're going to do this, we're going to do that, we're going to shoot the lights out, and the guy's going to say, oh, actually, I'm going to want 13% for that, you know. And then they run the numbers and say, actually, maybe we shouldn't be quite as bullish as we were. But I think for smaller businesses, I think you've got to look at leasing. Bank debt is difficult. You know, we're now regarded as one of the sin investments, aren't we? Which the first time I listed a business in about 2000, you know, we were overfunded actually. You know, we had a huge demand for the stock. The second time we did it, not quite so much. I don't think you'd get a business away, not a mid-market business now. You wouldn't get it away in gambling. You know, I think you've got to look for high net worth investment. You know, pretty savvy people who understand the industry and can ask the right questions. You know, of your management team.
I'm going to go right back to you with the next question and work back this way. With banks pulling back, we talked quite a bit about Cohort, but how can operators keep attracting capital? What would be your advice to operators in this market?
I think they've got to have a plan. You can't just rock up and say, okay, look, you know, we want to borrow X. You've got to say, okay, you know, we've got a fantastic business. We've developed a USP. This is what we're going to go for. We want the funding specifically for that, not for the rest of the business. You've got to be very honest with people. Yep. You know, because as I say, if you're talking about family offices or high net worth, they're going to be very, very scientific and very probing about what you want the money for. Mm-hmm. I think it's out there, you know, because the returns, as we know, are good, you know, but you can't bullshit people, you know. And there was an element of that in the early noughties, I think, you know, people were just taking a punt, you know, like everybody else, and they don't do that now. Excuse me, they're far more intelligent about it.
Thank you. Adam?
Well, those are great points. I would just add that the right plan is necessary, but the right people are as well. It's something Reuben and I were discussing before the panel. You know, there's a saying, what got you here won't get you there. There are some people who are excellent at creating or building a business, but might not be the right executive team to carry it forward and move it to scale and growth in the next level to attract institutional capital. So just being self-aware as to where your gaps are, being honest about them, having a plan, as Nick said, to put the right people in place to match the growth that you're trying to convince your capital partners that you can achieve is a critical part of the story.
Thank you. Reuben?
Yeah, I think there are some ingredients that need to be in place a priori before actually thinking of going for financing at this day and age. The first being that you need to have a strong balance sheet. So I come across a lot of gaming operators, mainly involved in the B2B space, so they're developing games. And you go to look into their balance sheet, and there's no figure that relates to the games that they developed. So they would have their core business is not reflected in their balance sheet. Why? Because as they develop games, rather than capitalizing the cost to develop the game and place it in the balance sheet, they place that cost as an expense under the P&L. So in reality, when you look at their balance sheet, there's nothing really strong to sustain. When you have, you know, somebody's going to come and finance your business, he needs to see that there's a strong balance sheet. So in that case, the balance sheet is actually lying, but that is what it is. So that is a priority to create the foundation. The second is that gone are the days that the gaming sector manages to do an EBITDA of, I don't know, 85 or 90%, when it was easy, you know, to go and finance. The reason being that now with most of the operators who are seeking this type of finance are moving away from black markets and gray markets. The margins are less because you are being involved in regulated markets which are high on maintenance costs in terms of compliance, etc. So you need to be seen attractive, not from your EBITDA, but from your reputation. And I think ESG is the key in order to attract financing, because let us, not kid ourselves. The gaming sector is a sin sector. They're sin shares, so they're considered to be the ugly duckling of all companies. So you need to project yourself that, yes, I am part of that sector, but I am above that. And with going with a proper ESG strategy and implementing ESG seriously, then shows that you are serious in what you do, you are responsible, you are also have very strong governance structures, and that can attract finance towards or you have a higher propensity to attract finance.
I'm going to try to, I have a bigger agenda than we have time, so what I'm going to try to do is go rapid fire on some questions, and then we'll move around. So maybe for you, Adam, we've been using the term ESG. Maybe you can put it in a context and explain how embracing ESG principles can improve investor confidence.
Well, in my opinion, the best businesses always had what's now been recast as ESG, or caring about social principles, or doing right while doing well. As my grandmother used to say, you could do well while doing good. So institutionalizing that is a healthy and necessary thing. Like anything else, it can go too far. And if it comes at the expense of growth and profitability and staying true to a company's principles, it's gone too far. But as I said, I think the sustainability of a business ultimately depends upon the support it needs from all of its constituents, not just investors, but also the communities around it, the regulators around it, its competitors, the people who work in the organization. And so being conscious of all of those constituents is critical for any business to really succeed. And I think if you look at the best companies, not just in gaming, but outside of gaming, they do it naturally. And institutionalizing it as part of the social fabric of the companies is just reinforcing what they've already been doing.
Yeah, well said. Nick, I'll go a different direction with you because you touched upon it. But if you're looking at mid-sized and family-run operators as opposed to the more corporate types, what should they be doing to stay investable?
To get ready for investment?
Yes.
I mean, I have this conversation often, and the first thing is get your accounts in order, get your business in order, behave more like a PLC with an ESG policy, report on that sort of thing. And of course, as we all know, I mean, at that level of the business, a lot of these guys are sort of buccaneers, and that comes hard. But you've got to say to them, look, if you want to reach out to institutions for more money, you want to get credibility, you've got to start behaving like a corporate. But without giving up your buccaneering principles, the thing that made you money, the thing that makes you an entrepreneur. It's a tough one. It's a real balance. But I tend to find that most people you talk to, eventually the penny drops, as we would say, and they get it. And they'll start to think about, or maybe they hire somebody actually that can do that, so they can go off and carry on being a buccaneer.
Great. Reuben, we were talking about this earlier, and given your background, you're a perfect person to answer this. How do market choices and license type impact a company's funding prospects?
Okay, so depending on the type of market strategy that you have, obviously then you would go down the route of whether to go for a multi-licensing approach, given that, at least from a European perspective, there is a fragmented way of how operators can operate. So you have to get if you're a B2C, you have to get a license from each jurisdiction. Same happens in the US. But we're seeing it to be a trend all across the world. So it depends on which markets you want to target. Not trying to chew more than what you can bite. The thing is, we've seen around 6-7 years ago, there was a big hype of everybody trying to go for the US market, for instance, without actually realizing how costly and the effort that you need to put in. And there's the business mindset is different from the European mindset. So we've seen practically everybody trying to go to the US and practically everybody moving out, except the ones who are really persistent and having deep pockets to keep on into that sector. So financing, obviously, whoever is going to finance you needs to see the return. Mm-hmm. So you cannot just, you cannot gamble on your business. We're in the gambling sector, but you cannot gamble on your business. So going for the right markets with proper analysis, proper research into how you can actually acquire more players, more revenue per player, etc. That is it's a key element that then obviously an investor would be looking into. If you're going to go for cohort financing, for instance, they want to see your track record in attracting players. And if they're going to finance that, they need to see that track record exists. So it's all about being consistent and having a clear plan of how to go about it, in my view.
Adam, as you think about some of the high-profile companies in the U.S. who have gone private or who have combined or consolidated, how should they be looking at opportunities, let's say, outside of the U.S. in other markets? What's your view on that?
Well, growth is key, and companies that stop growing, it doesn't mean they're uninvestable. It just means they attract a different kind of investor. So there are some businesses that are better designed to be slow grower dividend payers, and they will trade at a valuation that corresponds with that kind of a profile. But if companies want to keep growing, they need to be looking at additional markets or additional verticals. What's interesting is in the gaming technology public US arena, we've seen companies leaving the public sphere and going private. There are relatively few ways to invest in slot manufacturers in a public format these days. Some of that has to do with the desire to separate business strategies and try and create more value by being pure play businesses. There is a school of thought that investors like to make their own choices, and if you have too many businesses together in one pile, and the only way you could expose yourself as an institutional investor is to buy them all, the lower multiple businesses will drag down the higher multiple businesses, and therefore by separating them and putting a spotlight on individual values, you can create more value. And I think we've seen some of that. Light & Wonder has done that, IGT has done that, I'm sure there are others. And it raises the question of what's left to still pursue that strategy. And I'm not the first to realize MGM and Caesars have very large internet gaming businesses embedded within their public companies. And I would imagine at some point there will be a desire to put a spotlight on value through a separation strategy, through an investment into those businesses or something else. But that's the trend as I see it in the U.S. public markets.
Do you think, let's take MGM and Caesars as two examples, did they think they would be at a point sooner to be putting a spotlight? Has it taken longer? How much longer should we expect it to take?
Look, I don't have any particular knowledge about the strategies of those businesses, but they've both been successful at growing this vertical, this internet gaming vertical. It's a faster growing business than the traditional land-based business. So I couldn't put a timeline on it. It's always a challenge when you have a growing business that starts small, it will get big, and when you can hit that optimal point of monetizing it, combining scale and growth, there's no right answer. And of course, there are other things that these businesses have on their agenda besides just a spotlight on the value of these separate verticals. So the needs of the service of the debt service, the refinancing of maturing debt securities, the story that they need to continue to tell to their biggest institutional investors. All of these things go into the mix. So, I'm not smart enough to give you a prediction other than I would imagine it's on the play map for both of those companies to figure out how to get more value out of those businesses.
And one last follow-up on this point. Do you see another wave in the future of opportunities where companies from outside of the U.S. will come back in, a bunch rushed out, but could more come back in at a later date?
Yeah, I think you're already seeing that, whether it's with more in the private sphere, and again, this is all public consumption, but Allwyn has been making some investments in North America. Superbet has been making some investments in North America. So I think you're already seeing companies that began overseas trying to figure out how they can take advantage of what is still pretty early stage growth, not just in the US, but in Canada, in Latin America, so call it the Western Hemisphere.
Right. Nick, Adam touched upon this, but I'd like to hear your perspective. What can we learn from companies that separate their verticals in order to boost valuations? Of course, in brick and mortar casinos, there was a whole wave of companies separating the real estate from the operations. Now, as Adam alluded to, there are companies like Light & Wonder who are separating certain units, spinning off a lottery unit that may trade at a lower multiple. How would you look at that from your perspective?
I think it's a real conundrum, actually, for management, because I was just thinking about, as Adam was saying, you talk about Caesars or one of the other big properties. If you break away your online business, which is doing really well, are you going to get the support for your core business in the future? Or have you sort of marooned it? And is it just going to wither on the vine? I think that's something for management to think about. It's difficult. I think it's very tempting for a management team to separate those verticals. But I think it requires a huge amount of thought before you do that, because you might be throwing the baby out with the bathwater. And maybe it's better to continue with a slightly lower overall valuation, but a sustainable business for the future.
That's a good point. I guess we have about 4 or 5 more minutes. I think I'd like each of you to just take a piece of that and cover anything either that you've covered and want to emphasize, or something you didn't cover that you want to leave as an impression about this topic. Reuben?
One thing which I think and believe and see from the clients that we serve is a very key element is governance. Having key governance. Key governance is not going to help you only on financing. It's going to help you on everything, on your strategy, on the way how you administer your business. And governance is essential, I believe. And even touching upon what Adam and Nick were talking about in terms of when you come to the decision whether to split the various elements, cut the business in pieces in order to get a higher valuation, governance over there is also key, because you may be doing that thinking that you're going to get a higher valuation, but if you have a hidden assistant within the company, which is where you're spreading all your back costs, and by removing them, you're removing the economies of scale that brings into, you might be doing a disservice. Whereas if your business is already structured and in business units which are quite distinct from each other, then that is a bit painless to do, and then it would probably be the right decision to take. But in both models, governance plays a key element, because if you don't know what you're doing, how can you plan ahead?
Thank you. That's helpful. Thank you. Adam?
I would just comment on how the growing acceptance of game playing and gambling as a form of social entertainment is only going to increase, and that creates more and more opportunities to express a view with capital, and that's what investors do. And I'm reminded by some of the greatest investors who would say own everything, because there will be times when the sexy, shiny, fast-growing businesses do well, and there will be times when the older, slower grower, stable, slower moving businesses do well, and being able to adjust and reallocate is the best way to make a long-term return, as opposed to trying to pick solely which winners will succeed for short periods of time. So for me, it's about having a very broad set of exposure and reallocating as mood swings and pivots and social phenomena move. But the long-term tailwinds for our industry, I think, are terrific and only growing as we see increased convergence between games and betting and sport and media and brand and all kinds of businesses that used to be outside of our halls and conferences. We see them all now converging, and that's exciting. And it's an exciting time to be an investor in this business.
Yeah, well said. I'm saving seniority for last. You get the final word.
I was just going to say that I think the money is still out there, but I think you've got to be smarter about who you go to, where you go looking for it. And I think you've got to prepare everything before you talk to somebody. It might be somebody like yourself with a family office, and you get all your ducks in a row, as we would say. And then you say, this is the business I want you to invest in. These are the opportunities. Don't sit there, slack-jawed and say, actually, we've got a great business, but I can't tell you too much about it. You've got to be smart. I think smarter than you used to have to be in order to get the money to come in. And also work out whether you need it, actually. Yeah. You don't need to overfund the business at all.
Well, this has been a great panel. Let's have a big hand for this group. Thank you for